The world produces more silver than ever, yet physical supplies are disappearing faster than anyone admits. Industrial demand, from solar panels to electronics, has pushed consumption to unprecedented levels, while official inventories barely reflect the shortage, creating a paradox that confounds traditional market logic. Investors watch price charts that suggest abundance, but behind the scenes, refineries report delayed deliveries and rising premiums for immediate silver. This invisible scarcity signals a brewing tension in global markets that most analysts are not prepared to acknowledge. Paper markets dominate silver trading, allowing millions of ounces to be bought and sold without physically existing metal behind them. Futures contracts on exchanges such as COMEX create the illusion of ample supply. Yet actual delivery struggles hint at a disconnect between financial speculation and physical reality. Mint shipments to governments and private collectors are increasingly constrained, even as traders maintain stable prices, masking the underlying stress. The result is a dangerous illusion. Prices appear steady while real-world supply tightens quietly, unnoticed by the mainstream. For decades, silver has been treated as a secondary metal, valuable for industry, but ignored as money. Yet history shows that when monetary metals become scarce, economic shocks follow, destabilizing markets far beyond the metal itself. The current shortage is not just about industrial consumption. It reflects systemic pressures in debt-laden economies, where paper promises dominate over tangible assets. This tension is a warning signal, echoing past crises where metal scarcity foreshadowed broader financial instability. Even as miners ramp up production, they cannot keep pace with growing global demand, especially from renewable energy and high-tech industries. Governments and central banks add to the strain by selling or leasing silver at controlled rates, often disguising the real scarcity to avoid panic. Investors increasingly scramble for physical silver, paying premiums far above market quotes, while public markets remain calm and indifferent. This paradox of plenty, abundant paper, vanishing metal, sets the stage for a crisis that could ripple across currencies, industries, and international trade. Historical patterns reveal that scarcity often emerges silently before any price spike occurs. The 1970s Hunt Brothers episode is a prime example. Although paper prices were manipulated upward, the actual physical supply was insufficient to satisfy demand, creating market tension invisible to casual observers. Modern parallels are emerging as warehouse inventories decline and delivery times lengthen despite nominal price stability. The lesson is consistent. When physical supply diverges from financial claims, systemic risks quietly build beneath the surface. Industrial demand now accounts for over half of all silver consumption, a level unseen since the 16th century Spanish silver influx. Solar panels, electric vehicles, and electronics use silver in amounts that were unimaginable just decades ago, intensifying the strain on global reserves. At the same time, central banks and governments continue to sell or lease existing silver holdings, artificially suppressing market signals. This creates a dissonance where the world believes silver is abundant, even as it quietly slips into shortage. Market analysts often point to abundant COMEX inventories as proof that silver is plentiful. However, delivery-ready metal is shrinking, with premiums for immediate physical silver soaring far above paper prices. Refineries report bottlenecks and delayed shipments, while traders continue to paper over shortages with contracts that may never be fulfilled physically. The divergence between paper claims and physical reality is widening, signaling a structural flaw that has gone largely unnoticed by mainstream investors. The paradox is magnified by the opacity of global silver holdings. Unlike gold, silver is rarely held in transparent reserves by central banks, and private hoarding remains untracked, making supply dynamics nearly invisible to the public. Meanwhile, industrial and investment demand continues to rise unchecked, creating a silent tug-of-war between tangible metal and virtual ownership. This growing disconnect raises the question, how long can the system maintain the illusion of plenty before the physical reality asserts itself? Silver is both a commodity and a quasi-monetary asset, a dual role that magnifies its scarcity impact. When debt-laden economies lean on paper money, the need for tangible stores of value intensifies, and silver becomes a hidden barometer of systemic stress. The current market masks these tensions with stable prices, yet premiums for immediate delivery, production bottlenecks, and delayed mint shipments reveal the underlying strain. Investors and governments alike are operating in a shadow market, where scarcity exists even as financial instruments suggest abundance. Ultimately, the paradox of plenty is a warning that the world is repeating history in plain sight. Paper claims and industrial demand are outstripping actual supply, a pattern that has preceded financial disruptions from the Roman Empire to the modern Hunt Brothers crisis. This silent imbalance has the potential to ripple across currencies, trade networks, and industrial production if left unchecked. Understanding this hidden tension is critical because the physical reality of silver shortages may arrive faster than any market anticipates. Silver has long served a dual purpose as an industrial metal and a quasi-monetary asset that anchors trust in financial systems. When governments expand credit without restraint, the value of paper currency erodes, increasing demand for tangible metals like silver to preserve wealth and purchasing power. Throughout history, periods of rapid debt accumulation have coincided with rising pressure on monetary metals. In the 16th century Spanish Empire, massive silver inflows initially fueled trade, yet inflationary pressures and currency dilution soon followed, illustrating the tension between paper promises and physical reserves. Credit expansion acts like a hidden force, inflating financial claims while leaving actual metal supply stagnant. Banks and financial institutions issue more notes and contracts than there is silver to back them, creating a structural mismatch between paper markets and reality. Industrial use amplifies the strain as silver becomes consumed and unavailable for monetary purposes. By the early 20th century, U.S. coinage and industrial silver demands began competing for the same finite supply, revealing how dual-use metals accelerate scarcity under financial stress. Futures markets further distort signals by separating price from physical availability. On COMEX and LBMA exchanges, millions of ounces are traded in paper contracts, yet only a fraction can be delivered, masking the growing tension between virtual and tangible silver. Debt cycles magnify the effect. When governments run persistent deficits, they rely on currency issuance to finance obligations. This process devalues fiat money, incentivizing investors to seek silver and other tangible assets, pushing physical inventories toward depletion even as market prices appear stable. Leasing of silver by central banks or large institutions adds another layer of complexity. While these operations maintain the illusion of supply, they temporarily remove physical metal from circulation, exacerbating scarcity when demand spikes unexpectedly. Industrial adoption has historically amplified scarcity signals long before prices rise. For example, the rise of photography in the 19th century consumed enormous silver quantities, stressing markets in ways that financial charts failed to capture, foreshadowing broader economic pressures. Supply shocks compound the problem during periods of rapid economic expansion or geopolitical tension. Wars, mining strikes, or export restrictions quickly reveal the gap between paper commitments and actual silver availability, creating systemic strain invisible to casual observers. Debt-driven economies often suppress price signals through regulatory or market interventions. By fixing lease rates, controlling exports, or influencing futures prices, authorities maintain apparent stability while shortages quietly accumulate in physical inventories. The divergence between paper claims and tangible silver highlights a fundamental flaw in modern financial architecture. When contracts vastly outnumber available metal, the system is vulnerable to shocks that can trigger rapid repricing and delivery crises, as history repeatedly demonstrates. Silver's role as a monetary hedge becomes critical during inflationary cycles. Investors increasingly convert paper assets into physical metal, accelerating depletion and creating tension between industrial demand, investment demand, and limited supply. Backwardation, a market condition where near-term delivery is more expensive than future contracts, often signals underlying scarcity. Historical patterns show that such anomalies appear long before prices reflect the shortage, serving as early warning indicators for systemic stress. Geopolitical concentration of silver mining amplifies vulnerability. Major producers like Mexico, Peru, and China dominate supply, and disruptions due to political instability, labor strikes, or environmental regulations can rapidly tip the delicate balance between demand and availability. Ultimately, recurring patterns reveal that silver scarcity is rarely caused by a single factor. Instead, it emerges from the interaction of debt expansion, currency dilution, industrial consumption, and market structures that separate price signals from physical reality, creating systemic stress long before prices spike. Global silver production has reached over 25,000 metric tons annually, yet industrial and investment demand consistently outpaces supply. Renewable energy technologies, electric vehicles, and electronics consume an unprecedented portion of this output, creating stress on inventories that often goes unreported in mainstream market analysis. Major exchanges such as COMEX and LBMA dominate trading, with millions of ounces represented on paper, contracts far exceeding physical inventories. This imbalance allows prices to remain relatively stable despite underlying scarcity, masking systemic risk and disconnecting financial perception from physical reality. Warehouse inventories in major hubs show declining delivery-ready silver, even as futures contracts and paper markets suggest abundance. Investors seeking immediate physical metal encounter rising premiums, signaling the growing tension between tangible supply and financial claims. Central banks and government policies contribute to the distortion by leasing or selling silver at controlled rates. These interventions maintain the illusion of stability while quietly draining inventories, a recurring pattern observed throughout history whenever silver scarcity coincides with debt-driven economies. Industrial demand now accounts for over 50% of global silver consumption, a historic peak unseen even during the 1970s Hunt Brothers episode. Photovoltaic panels alone consume hundreds of millions of ounces annually, with demand projected to grow as renewable energy adoption accelerates worldwide. Electric vehicle battery production adds another layer of pressure, as silver is a key component in conductivity and energy efficiency. This concentrated industrial adoption mirrors historical cases, where dual-use metals faced competing monetary and industrial demands, exacerbating scarcity in silent markets. Energy costs and geopolitical instability further complicate supply. Declining ore grades and rising extraction costs limit production growth, meaning even mines operating at full capacity cannot prevent physical scarcity from emerging during demand surges. China dominates both production and consumption of silver, creating a geopolitical vulnerability for global supply. Export restrictions or domestic prioritization of industrial needs can ripple through international markets, intensifying scarcity pressures in regions dependent on imported silver. The COVID-19 pandemic exposed additional fragility in supply chains, with mine closures and transport disruptions delaying delivery of physical silver. Industrial demand rebounded faster than production, highlighting the system's limited ability to respond to sudden shocks without escalating premiums or delivery bottlenecks. Technological advancements have increased silver recycling efficiency, yet recycled silver still accounts for less than half of global consumption. This shortfall underscores the persistent gap between total demand and deliverable supply, reinforcing the structural scarcity embedded in modern markets. The divergence between paper and physical silver is amplified by speculative trading, with hedge funds and financial institutions holding large positions in futures contracts. While these positions create liquidity, they obscure actual supply constraints and can exacerbate volatility when physical delivery becomes a requirement. Premiums for immediate physical delivery often rise faster than spot prices, a signal historically associated with systemic stress. Backwardation in silver markets today mirrors patterns observed during the Hunt Brothers episode, validating historical lessons on scarcity signals preceding price spikes. Industrial silver stockpiles are increasingly concentrated among a few major corporations, creating fragility in the supply network. If one large player faces disruption, the ripple effect can strain global production and delivery, illustrating the systemic nature of modern scarcity. Investment demand continues to rise as paper money expands and confidence in fiat currencies fluctuates. Silver, as a tangible hedge against inflation and financial instability, experiences growing pressure, particularly when industrial consumption already consumes the majority of production. Global energy shortages and rising costs add to mining and refining constraints. High electricity prices, environmental regulations, and geopolitical conflicts in mining regions limit the ability to expand production, intensifying supply pressures even as demand grows. The concentration of silver production in Mexico, Peru, and China creates further geopolitical vulnerability. Political instability, labor disputes, or regulatory changes in these regions could trigger rapid physical shortages, reinforcing the pattern where physical scarcity precedes market recognition. Central bank holdings of silver are minimal compared to gold, and transparency is limited. This lack of official reserves means markets have fewer buffers against shocks, amplifying the impact of physical shortages on both industrial and investment demand. Global trade flows reveal that physical silver is increasingly redirected toward high-priority industrial sectors. Traditional monetary or investment demand must compete for the remaining supply, creating localized shortages and premium spikes unseen in paper markets. Warehouse audits and delivery statistics indicate declining silver availability, particularly in North America and Europe. Despite this, futures markets maintain stable prices, highlighting the growing disconnect between physical reality and financial perception. Modern markets also face the lingering effects of speculative positioning and leveraged paper contracts. When delivery obligations collide with physical scarcity, even small disruptions can trigger outsized price movements, echoing the Hunt Brothers' legacy and earlier historical episodes. The persistent gap between industrial demand, investment interest, and mine output signals an ongoing systemic stress. Historical patterns suggest that the longer this divergence persists, the more abrupt and severe the adjustment will be when physical realities assert themselves in the market. Technological and geopolitical shifts continually reshape silver demand and supply, often faster than the market can adapt. Historical parallels demonstrate that such rapid changes, combined with leveraged paper markets, create conditions ripe for price spikes and delivery bottlenecks. The modern silver market, dominated by industrial consumption, speculative contracts, and constrained physical supply, mirrors the conditions that historically preceded crises. While prices remain relatively stable, premiums for immediate delivery and backwardation indicate the market is quietly signaling the underlying scarcity to informed observers. Investors, miners, and policymakers are operating in a delicate balance where paper markets obscure the physical scarcity of silver. Recognizing these patterns is essential to anticipate broader financial and industrial stresses, making silver not merely a metal, but a critical barometer of global economic health. The systemic dynamics of modern silver markets reveal that scarcity today is less about visible shortages and more about structural imbalances between supply, industrial demand, and paper trading. When historical patterns are applied, it becomes clear that current market stability is fragile, resting on assumptions that physical realities may soon challenge. Persistent silver scarcity will likely strain industrial production, particularly in high-tech and renewable energy sectors. Shortages of conductive silver for electronics and solar panels could slow technological adoption, forcing companies to delay projects or seek costlier alternatives. Rising premiums for immediate delivery indicate that physical silver is increasingly constrained, even as paper markets remain calm. This divergence risks sudden price spikes when large-scale industrial demand collides with limited supply, creating systemic stress across global markets. Backwardation in silver markets is a warning signal of immediate physical demand exceeding available metal. Historical patterns suggest that such conditions often precede broader disruptions, where paper contracts are unable to satisfy real-world industrial and investment obligations. Global trade flows could experience bottlenecks if silver shortages persist. Countries reliant on imports for industrial silver may face production delays, rising costs, and reduced competitiveness in international markets, affecting both manufacturing and economic growth. Central banks and government interventions can temporarily suppress price signals but cannot create new metal. Leasing, sales, or stockpiling policies may mask shortages in the short term but contribute to systemic fragility by reducing inventories available for industrial and investment demand. Investment demand for silver as a hedge against inflation is rising, particularly amid growing debt and currency expansion. As investors increasingly seek physical metal, available supply tightens further, intensifying pressure on industrial users and magnifying market stress. Technological dependence on silver compounds the problem, as substitutes are often less efficient or more expensive. High-demand sectors like photovoltaic cells, medical devices, and electronics may face supply constraints, forcing innovation cycles or price adjustments under pressure. Energy costs and geopolitical instability can exacerbate mining constraints. Production delays due to rising electricity prices, labor strikes, or regulatory interventions in major producing countries could rapidly reduce available silver for industry and investors alike. Speculative positions in futures markets may amplify price volatility during periods of physical shortage. When paper contracts demand delivery, sudden market adjustments can trigger cascading effects across exchanges, warehouses, and industrial supply chains. Recycling silver can alleviate supply stress, but it remains insufficient to meet growing industrial demand. Delays in reclaiming and processing scrap metal leave short-term shortages unaddressed, highlighting structural imbalances in the global supply chain. The concentration of silver production in a few key regions adds systemic risk. Political, environmental, or economic disruptions in Mexico, Peru, or China could trigger immediate scarcity, reverberating through global manufacturing and financial markets. Debt-driven economies intensify the tension as investors increasingly view silver as a hedge against currency devaluation. Rising demand for tangible assets accelerates depletion of physical inventories, making structural shortages more acute over time. Technological and industrial expansion in renewable energy projects creates persistent long-term demand pressure. Without substantial increases in mine output or alternative materials, production delays and cost inflation are likely to intensify globally. Central banks' minimal silver holdings provide little buffer against systemic shocks. Unlike gold, the absence of official reserves leaves industrial and financial sectors vulnerable when shortages emerge, forcing rapid market repricing under constrained supply conditions. Historical patterns suggest that supply stress often precedes price correction by months or even years. Recognizing the lag between physical scarcity and market pricing is crucial to anticipate systemic disruptions before they escalate into crises. Silver shortages may also affect monetary stability indirectly, as tangible assets become a preferred hedge against inflation and currency instability. Large-scale shifts into silver can divert investment from other sectors, altering capital flows and potentially affecting broader economic growth. The interaction of industrial demand, investment pressure, and limited mine output creates a perfect storm for market stress. Without timely interventions in mining, recycling, and supply chain management, global markets face the risk of sudden, destabilizing price spikes. Silver shortages are not just a supply problem. They are a symptom of structural imbalances in global economies. Debt expansion, industrial growth, and leveraged paper markets interact to create scarcity signals long before prices fully reflect them, revealing the fragility of modern financial systems.